Condo prices are going to crash in 2024, and this is why. As of 2024, condos are going to be required to carry reserves, which are going to drive down the values and drive up the association fees for these buildings. But what's causing that to happen is the condo collapse in Surfside, Miami, Florida. So I'm going to talk about the Surfside collapse and how that's affecting the real estate market when it comes to condos, the 2022 Condo Safety Act that's going to require these condominiums to implement these reserves, the Condo Reserves in general and what's required, condo financing both before this act was put in place and after, condo financing and the key factors that lenders are looking at when reviewing a condo for a mortgage, affordability of condos and how these changes with reserves are going to make properties less affordable than they previously were, how comparables work when looking at one condo compared to another and the prices, and how to find condos that are approved for financing. So let's talk about the Surfside collapse. So in June of 2021, there was a 12-story building in Surfside, Florida, which is in Miami, Florida, right on the beach, that collapsed suddenly. Now, it's still under investigation as to what caused the collapse, but the current investigation showing that it was due to deferred maintenance or items that were overlooked and not repaired that should have been taken care of years prior. Now, it's this overlook or this oversight of these items that should have been repaired that has now caused other condominiums to be affected. Condominiums are required to have inspections done every 10 years to determine if there's any maintenance that needs to be taken care of on the property. A lot of the older condominiums are going through their 40-year inspections because they haven't had them done previously. And these 40-year inspections are actually bringing lots of issues to the surface that should have been addressed decades prior. Now, the 2022 Condo Safety Act is going to require condominium associations to put reserves in place for things such as deferred maintenance when it comes to balconies, elevators, fire systems, stucco work. Right? There's a multitude of things that would have to be covered by these reserves, but the reserves need to be there when they, in the past, were not. So not having the reserves has caused issues with being able to repair these things in a timely manner. The key points of the Safety Act are going to be that condominiums that are 3 stories or more and located within 3 miles of the coast are going to be required to have these reserves. And they're going to check the structural integrity from 30 years ago and every 10 years going forward. Buildings located within 3 miles of the coast are going to be inspected at every 25 years and every 10 years after that. So every decade, there's going to have to be inspection done on these buildings. The milestone inspection is going to find evidence, if it does, of substantial structural deterioration. A follow-up inspection needs to immediately take place from a different inspector. If the association fails to submit proof that any repairs have been scheduled or began within a year of the follow-up inspection, the local enforcement agency is required to review and determine if the building is safe to occupy. Prospective buyers must receive a copy of the inspector-prepared summary of the milestone inspection report from the seller when they submit an offer on the property. Any building with a certificate of occupancy that was issued prior to July of 1992 is subject to a Phase 1 inspection before the end of 2024. Now, let's talk about the condo reserves, right? Some condominiums have always budgeted for reserves, but you're going to find there are a lot, especially the older condominium buildings, that just don't budget for reserves, because what happens is when you budget for reserves, it makes the monthly association fee for each unit higher because money's being allocated to another account. So that money has to come from somewhere. It's coming from the unit owners, and it comes from the unit owners in the form of the homeowners association fee. But the problem is when you have these boards and you have the unit owners voting for what budget to go for from one year to the next, they're deciding to go with the cheapest budget, which in most cases does not account for reserves. So now that there's going to be reserves required, it's going to drive up the association fees for the buildings that weren't already accounting for reserves. But what happens when there aren't reserves? Well, that's when special assessments come into play. A special assessment or additional charges to cover the replacement of items or repair of items that can't be covered by funds that might already have been set aside by the association. If there are no reserves set aside, well, there's no money for these repairs or replacement if necessary. And so that's where you hear of special assessments being put in place on condominiums and the unit owners. There's a building in Miami that recently received a special assessment of $150,000 per unit owner. Not total, that's per unit owner within the condominium project. Just imagine that you're having to come up with $150,000 either as a lump sum or paid out over time to catch up with where the reserve should be for the association. It's crazy. It's making what was once the most affordable property type, a condominium, or in most people's eyes, the most affordable property type, the most unaffordable property type. Now, when it comes to condo financing, there's always been a process that we as lenders have to follow when reviewing the condominium on top of reviewing the borrower, right? And so prior to these changes, what we would look at, if we're doing what's known as a limited review, there are two types of reviews that lenders can do when you're obtaining financing on a condominium, is there's a limited review. A limited review is going to be determined by the amount of money you're putting down. So just to keep it simple, if you were buying a condominium in Florida to live in, if you're putting 25% or more down, a lender would do a limited review. Limited means less, right? We know that. So we would do a short form condo questionnaire. It's just a minimal number of questions that are listed out that the association is going to answer for us, primarily dealing with whether or not there's any litigation. So is the association involved in any lawsuits? And we get a copy of the master insurance policy. When there's a condominium, there's a big insurance policy that covers the building as a whole. And so the lender on a limited review will look at those two things and make their decision as to whether or not we can lend on the project just based on that. If you were putting less than 25% down and buying a condominium as a primary residence, then a full review would be done. So it would be a longer version of the condo questionnaire. Again, it would be the master insurance, but we would also get a copy of the budget and the bylaws of the condominium. So it's a little more extensive review, but in most cases, a condo can pass those things and you'd be able to get financing on the condominium. What's happened since this was implemented is we need all of the items above. If it's limited, what's needed for limited. If it's full, what's needed for full. But on top of that, there's a structural addendum that's going to be attached to the limited review and attached to the full review. Structural addendum is looking for any sort of deferred maintenance there might be, either that was called out on a 10-year or 30 or 40-year inspection that's currently in place being worked on or is going to be worked on with a special assessment in the near future. If there are health and safety related items that are currently being worked on in a condominium, it's going to be near impossible to get conventional financing in that condominium until it's complete. Sounds crazy, but those are just the rules that Fannie Mae and Freddie Mac have put in place when it comes to condominium financing, and they're extremely strict on those rules. Now, the condo financing key factors, so things that we as lenders are going to be focusing on, are going to be the approved budget. As far as reserves are concerned, if this is a full review, in that budget, we need to see that the association has allocated at least 10% for reserves. So if it's $1 million budget, $100,000 of that million, so 10%, is what we would need to see has been allocated specifically for reserves in that year's budget. The master insurance policy, I mentioned that there's a master insurance policy that covers the building as a whole. We need to make sure that the master insurance policy has the correct coverage that lenders want to see, which is called RCV coverage, replacement cost value. What we don't want to see is ACV coverage, actual cash value. I'll give you a comparison of what these are. Replacement cost value is what something would cost to replace today. So we know that anything you own in most cases goes down in value as you use it. You take a car, for example. As you drive your car around, put miles on it, and years pass, your car is going to be worth less than it was the day you bought it new, if you bought a new car, right? Replacement cost value insurance if something were to happen to your car, right, same thing with the property, would replace your car in full with a new version of that car, regardless of what the car is worth today. So if you spent $30,000 on a car, it's worth $15,000 today. You total the car, they're going to replace the car with the same type of car you had. They're going to replace the car whether it costs $30,000, $20,000, $25,000, it doesn't matter. They're still going to replace it because you're getting replacement cost, right? Same thing goes with the property. That's what lenders want to see a building has. What we don't want to see is actual cash value. I'll give you the same example of the car. You bought a car for $30,000, it's now worth $15,000 because it's depreciated in value. You total that car. Actual cash value would only give you what the car was worth today, not what it would cost to replace it. So the problem is you're going to get $15,000 for that car as an example, but it's going to cost you $30,000 to replace the car. So you don't have enough money to replace the car. Same thing goes with the property. If the roof to the building gets destroyed and it's $100,000 to replace the roof, and you don't have a replacement cost value policy of actual cash value, and the value of the roof is $50,000, that means that you're only get $50,000 to replace the roof, which isn't enough to replace the roof. So that's the issue. Lenders need to see replacement cost value. We are seeing a lot of master insurance policies that are going with an ACV option because it's cheaper, and because a lot of these master insurance providers are unwilling to insure roofs on buildings that are more than 10 years old. So it's definitely something we're running into often that's causing a problem with lending on buildings. And then, as I mentioned already, special assessments for deferred maintenance. If we get a questionnaire back along with the structural addendum that I mentioned for a building, and it says that there's deferred maintenance, meaning things that have to be fixed, and there's a special assessment on its way for those things, you are not going to be able to get a mortgage in that property until the work is complete. Even if they have the work scheduled, if it's health and safety related, which most structural items are, you will not be able to get financing until the work is done. Now, what is going to happen with condominium prices and the affordability on condominiums with these new changes? So I said that if you're going to have special assessments, that money has to be collected from the unit owners. I mentioned the $150,000 per unit, which is a little extreme, but that's a real situation. But let's just say that it's less than that, and now that money has to be collected from the unit owners. Well, it's going to be collected in the HOA fee. So let's just say you had a $300,000 condominium whose HOA fee was always $300 per month. This HOA fee is now going to increase because of a special assessment for deferred maintenance to $600 per month, right? So it's going to double. So what's going to happen to the value of that property if the association fee doubles? Well, what just happened was the property became less affordable, which made it less desirable to buyers. Because as I said, condos are usually looked at as a more affordable property type. But as the association fee increases in the condominium, the property becomes less affordable. But if you have a buyer who strictly wants the condominium, what are they going to do to account for a now higher association fee? Well, what they're going to do is they're going to offer you less for the property. So they are going to determine, okay, if I'm going to pay $300 more per month in my association fee, I'm not going to offer $300,000 for this condominium. I'm going to offer less. So how much less do I need to offer to make up for the additional $300? So that could be a difference of hypothetically $50,000. So instead of offering $300,000, they may offer you $250,000 if you're the condo owner in order to account for the now higher association fee. Because now their monthly payment is going to be the same as it would have been if they paid $300,000 with a $300 association fee. But they're not going to give you that money because they don't feel the property's worth that any longer because the association fee is so high. Add to that the fact that if you can't obtain financing in the condominium, it's going to reduce the buyer pool because there's not that many cash buyers. They're out there, but it's definitely less limited than those with financing. So if you're eliminating your buyers with financing and you're only dealing with cash buyers, well, what's going to happen is that price is going to go down even further. So the less affordable a property is, the less desirable a property is, the less you're going to get in sale price for that property. So it's important to keep that in mind if you're considering condos. You don't just want to think about yourself. You want to think about what the potential issues you might experience would be if you bought the property and then you went to sell that property. How do the comps work, comparable sales, when doing that? And how will they affect your resale value of the property if you were to purchase a condo? So let's just say that in 2022, a condo's value might have been $500,000. And now we're 2023, there was a special assessment on that condominium, drove down the price to $400,000. What's going to happen in 2024? How is that property going to appraise? What comparables are going to be used to determine the value of the property? Well, let's just keep this really simple. Let's assume that an average will be used to determine the value of the property. Normally it's going to be based on the more recent sales, but let's even just do an average here and say that the average sale is going to be around $450,000, assuming everything stays the same in 2023, or sorry, in 2024 that it was in 2023. But we know that's not going to be the case. We know from what I just told you that it's likely you're going to see special assessments. We're going to increase the association fees and therefore drive down these prices even further. But when looking at comparables, an appraiser or even a buyer who's paying cash is going to look at the most recent sales of properties in the immediate area that are comparable to yours. If you have a 2-bedroom, 2-bath condo, they're going to be looking at other 2-bedroom, 2-bath condos, and something that they're going to be taking into consideration now that they may not have been taking into consideration in the past are the pending special assessments and are there reserves for that condo? Because they know if there are no reserves, there are definitely going to be pending special assessments, which are going to increase those dues, as I've said, and drive down those prices, which is going to reduce the amount they plan to offer on the property even further. Now, how do you find condos that are approved for financing? Right? I've talked about how difficult it's going to be, how difficult it's already become, but I don't want it to sound like you can't get financing on condominiums. Of course you can get financing on condominiums. It's not going to go away. There's just going to be some that you can't get financing on. So how do you find the buildings that actually qualify for financing? Well, Fannie Mae actually keeps a log of all approved condos in the United States, and your lender should be able to check this for you. Once they have you pre-approved for a mortgage and you're out shopping for properties, if your primary focus is going to be condos, make sure to speak to your lender and ask them to check the Fannie Mae approved list in whatever city or state, wherever it is that you're looking. I know I can run a search for a specific city or county for my clients and say, hey, if you're gonna be focusing on condominiums specifically, these buildings have already passed a full review, right? Meaning the questionnaire with the budget, with the bylaws, right? The structural addendum, those have already been reviewed and passed with Fannie Mae, and these buildings are eligible for financing. You're not going to run into the issues that we're seeing on some other buildings if you focus on these. It's going to save you time, it's going to save you money, it's going to save you heartache because you know you're looking at properties that you'll be eligible to buy with a mortgage. And like I said, so your lender should have access to this list. If they don't, then you probably want to link up with a lender who does, who can provide you with that helpful information to go with your condo search. If you have more questions on condo financing, or really any questions on mortgages in general, make sure to comment below. I do reply to 100% of the comments that you make, and make sure to follow me and subscribe for more great videos just like this one.